So imagine a single company making $81.6 billion in just 90 days.
Yeah, that is a wild number to even try to think about.
Right. I mean, it's literally more money generated in one single quarter than this exact same company made in an entire year, just, I think, 3 years ago.
Oh, easily. Yeah, it's just massive.
And they completely shattered every conceivable Wall Street expectation. Like, they announced this massive, unprecedented dividend increase. They're essentially just minting cash right now. And the stock market, well, it basically yawned. The stock actually went down.
Which is honestly the ultimate paradox of modern finance, because you have what is arguably the most fundamentally flawless corporate performance in modern history, right? And it's met with just a collective shrug from the people who actually trade the stock.
It makes no sense. But before we get too deep into all that, welcome to the Time and Market Deep Dive. As a reminder, this is just for entertainment purposes, so please seek professional advice for your own investments. Because today, the mission for you listening is to really understand the mechanics of this paradox.
Definitely.
We are looking at Nvidia's Q1 fiscal 2027 financial results. And we're pulling from their official earnings call transcripts, their press releases, and some really great deep dive financial analyses from places like SiliconANGLE, The Motley Fool, Investing.com, Tom's Hardware, and Al Jazeera.
And, whether you actually hold Nvidia stock or not, you live in an economy that is increasingly run by artificial intelligence.
Which is basically everyone listening at this point.
Exactly. Yeah. So understanding what Nvidia is doing right now is, I'd say, mandatory because they are fundamentally changing how the global economy operates.
They really are. And we have to start with the sheer scale of this financial report because it's honestly difficult to conceptualize without the context.
Yeah, when you see $81.6 billion in revenue, which, by the way, is up 85% year over year.
Wow.
And 20% sequentially, you have to realize that 20% sequential growth means this is their 14th straight quarter of accelerating revenue.
13th straight quarter.
Right. And for a hardware manufacturing operation, dealing with physical supply chains, rare earth metals, global shipping, achieving sequential growth of that magnitude for over 3 years is just unprecedented.
I want to stop on the profitability for a second, though.
Right.
Because, bringing in revenue is one thing, but actually keeping it is another entirely.
Oh, absolutely.
Their net income was $58.3 billion.
Yeah.
That is up 211% year over year. But the figure that really demands an explanation here is their gross margin. It is sitting comfortably at roughly 75%.
Which is wild.
How does a company that builds physical, highly complex, resource-intensive hardware maintain software-like margins of 75%?
Well, that margin is, it's the clearest indicator of absolute monopoly pricing power and honestly a severe supply constraint.
Okay, unpack that a bit.
So gross margin is essentially what's left after you subtract the direct costs of creating the product.
Right.
In normal hardware manufacturing, think televisions or smartphones, margins are razor thin.
Because everyone's competing on price.
Yeah, exactly. If you charge too much, a competitor just undercuts you. But Nvidia is achieving 75% margins because they basically have no true peer right now in the high-end AI compute space.
Right.
If it costs them, say, $10,000 to manufacture a chip, they can charge $40,000 for it, and companies will gladly pay it because they literally have no other choice.
Wow.
The demand, as CEO Jensen Huang noted on the call, has essentially gone parabolic.
Okay, parabolic demand sounds great on an earnings call, but I have to challenge the reality of that a little bit.
Sure.
Because at what point does this hit a hard ceiling? We can't simply assume that these massive tech conglomerates have infinite cash reserves to keep buying $40,000 chips forever.
Right.
It feels like a sports team that just broke the all-time scoring record, but the fans are yawning because, well, they expected it.
Yeah.
There has to be a saturation point, doesn't there?
You would assume that if you view these chips as a traditional capital expense, but the paradigm shift we're seeing in the market right now is that customers aren't treating these chips as a sunk cost anymore. They are treating them as direct revenue-generating assets.
Oh, interesting.
Yeah. On the earnings call, Huang specifically made a point to say that tokens are now profitable.
Okay, let's clarify what a token actually is for the listener, because that term gets thrown around a lot in these financial reports without much actual definition.
Good point. So think of a token as the fundamental unit of currency in an AI model's brain.
Okay.
It represents a chunk of text, maybe a syllable, a whole word, or even a piece of an image. When you ask an AI a question, it processes your prompt in tokens and it generates its answer in tokens.
Got it.
And historically, the computing power required to generate those tokens was, well, astronomically expensive.
We were basically burning cash for every prompt.
Exactly. You were losing money every time the AI answered a user. But Huang is declaring that the cost to generate these tokens has plummeted so much, thanks to their hardware efficiency, that the companies deploying these chips are finally making a clear profit on the AI's output.
Ah, so that completely changes the math for the buyer.
Totally.
Because if the machine prints more money than it costs to run, you're obviously just going to buy as many machines as you possibly can.
Right. It's a money printing press at that point.
Which explains why Nvidia is swimming in so much cash. They returned a record $20 billion to shareholders this quarter alone.
Yeah.
I mean, they hiked their dividend by an eye-watering 2,400%, from a single penny to 25 cents a share.
It's crazy.
And they added an $80 billion share repurchase authorization. Like, they literally cannot reinvest the cash into their own business fast enough.
Precisely. I mean, they're buying back their own stock because the physical limitations of their supply chain prevent them from just spending that $58 billion net income on manufacturing more chips. They physically can't build them fast enough.
That is wild. And that physical supply constraint perfectly explains, I think, the massive structural shift hidden inside this earnings report.
Yeah, the resegmenting.
Right. Nvidia is completely changing how they classify their revenue and report their business to Wall Street. They are officially dropping gaming and professional visualization as standalone reporting categories.
Which is huge.
Right. The company that basically built its entire empire, making PC games look realistic, is telling the world that gaming is now essentially an afterthought.
It is a really profound psychological pivot for the company. Those older categories, the ones that made them famous, are now simply folded into a bucket called edge computing.
So lumped in there.
Yeah. The entire reporting framework has been streamlined into just two main platforms now, data center and edge computing.
And when you look at the data center segment, which is obviously the engine of the whole company, they've split it into two submarkets.
Right.
You have hyperscale, which makes up about 50% of the data center revenue, roughly $38 billion this quarter. And these are the massive public clouds, right? Like AWS, Microsoft Azure, Google Cloud.
Exactly, the usual suspects.
That is expected. But the second submarket is where the real narrative is hiding.
Yes. The second segment is called ACIE, which stands for AI Clouds, Industrial, and Enterprise.
Okay.
And that segment brought in $37 billion this quarter.
Almost the same as hyperscale.
Exactly. So you have hyperscale at $38 billion and ACIE at $37 billion. They're nearly identical in size, but the trajectory of each is entirely different.
How so?
Well, hyperscale grew 12% sequentially. But the ACIE segment grew 31% sequentially.
A 31% jump quarter over quarter is just staggering. But tell me, why does this ACI segment matter so much to the listener? Like, if I'm not running a massive tech conglomerate, why should I care that industrial enterprise AI is growing faster than cloud AI?
Because it signals that artificial intelligence is moving out of the theoretical, digital realm of big tech, and it's slamming right into the physical, everyday economy.
Where?
ACIE growth basically means that local manufacturing plants, city governments, healthcare networks, logistics companies, they are all building their own dedicated AI infrastructure.
Wow.
It is no longer just a chatbot hosted on a server out in California. It's industrial infrastructure localized in your own community. And a major driver of this ACI segment is something called sovereign AI.
Sovereign AI. That sounds incredibly geopolitical, actually. Are we talking about entire nations treating AI infrastructure like national defense assets?
That is exactly what is happening. The sources highlight that Nvidia's technology is now deployed across 40 different countries, representing $50 trillion in global GDP.
50 trillion.
Yeah. Nations like India, France, Japan, they've realized that if they rely entirely on American tech giants to process their citizens' data and, run their national grids, they completely lose their digital sovereignty.
Right. They're at the mercy of another country's corporations.
Exactly. So governments are stepping in and buying Nvidia chips at scale to build state-owned AI factories.
To give the listener a physical sense of what this scale looks like, the sources note that partner data centers exceeding 10 megawatts of power have nearly doubled to over 80 sites.
Yeah.
I want to linger on that 10 megawatt figure for a second. What does a 10 megawatt facility actually look like in the real world?
It is essentially heavy industry. A 10-megawatt data center consumes enough electricity to power roughly 10,000 homes.
Oh my goodness.
We are talking about massive concrete structures. They require industrial-grade cooling systems, specialized power substations, and highly reinforced architecture just to support the sheer weight of the server racks.
Wow.
The fact that the number of these massive nation-state level facilities has doubled in a single year just goes to show that Nvidia is no longer just selling computer parts.
No.
They are literally selling the critical infrastructure of the 21st century.
Which naturally brings up the immediate question of the hardware itself.
Yeah.
If Nvidia is powering these sprawling city-size AI factories, we really need to understand the physical machinery driving this shift.
Right.
Now, the market has been hyper-focused on their Blackwell architecture, and the earnings call noted that Blackwell is currently experiencing the fastest product ramp in the entire history of the company.
Yeah, and the demand for Blackwell is so intense right now that it is actually warping the pricing of their older hardware.
Really?
Yes. The sources indicate that prices to rent the older previous generation H100 chips are actually up 20% year to date.
Wait, normally when a new Keck product launches, the old version gets way cheaper.
Exactly. But because companies literally cannot get their hands on enough Blackwell chips, they're fighting over the older H100s, which is driving the price of last year's technology up.
That is insane. But Nvidia is already kind of cannibalizing its own success here. They aren't waiting for Blackwell to peak.
Not at all.
They announced they are moving to the next generation, the Vera Rubin platform, which starts shipping in Q3. And the most disruptive piece of hardware in this new platform isn't even a GPU, it's the Vera CPU.
And this is just a monumental shift in their strategy. Like, Nvidia is famous for the GPU, the graphics processing unit, but the Vera CPU is the world's first central processing unit, purpose-built for what they're calling agentic AI.
The distinction between a GPU and a CPU is super vital here. Why does a company that absolutely dominates the GPU market suddenly care so much about the CPU?
It all comes down to how they process information. So a GPU is designed for parallel processing. It can handle thousands of simple mathematical equations at the exact same time.
Right.
It's the brute force required to train an AI model. A CPU, on the other hand, is a sequential processor. It's the traffic cop.
Oh, okay.
It handles complex logical tasks one by one, and it basically orchestrates the entire system. Historically, NVIDIA handled the brute force, and companies like Intel or AMD provided the traffic cops.
But agentic AI changes the requirements of that traffic cop. Let's define agentic AI, because we're moving far beyond simple chatbots here.
Way beyond.
Agentic AI refers to artificial intelligence. They can use external tools, act autonomously, and actually do productive, multi-step work without human intervention.
Yes.
The best way to visualize this is moving from AI as a super smart calculator that patiently waits for you to type a question to AI as a fully autonomous intern.
That's perfect.
You give the intern a broad goal, like research our competitors and build a presentation. And the AI goes off, opens the internet, compiles the data, writes the code, and builds the slide deck entirely on its own.
That is an excellent analogy. And to manage a system where billions of autonomous AI interns are constantly interacting with different software tools, accessing memory, and completing multiple tasks, the old architecture just breaks down.
You can't handle it.
Right. Jensen Huang explained that the traditional metric in cloud computing was dollars per core. The more cores you bought, the more value you got. But the new metric for the agentic AI era is tokens per dollar over the entire lifetime of an AI factory. The Vera CPU is specifically designed to orchestrate these billions of AI agents super efficiently. It handles the scheduling, the memory management, the logic, allowing the GPUs to just focus entirely on the heavy thinking.
This opens a staggering financial frontier for them. The sources indicate the Vera CPU opens a brand new $200 billion total addressable market for NVIDIA.
Yeah.
They already have visibility into $20 billion in standalone CPU revenue this year alone. But I actually want to push back aggressively on this strategy for a minute.
Go for it.
By pushing so hard into the CPU market, aren't they stepping directly into the territory of their longtime partners? Like, they are risking their focus.
Sure.
There's a massive graveyard of tech companies filled with hardware manufacturers who tried to own the entire ecosystem, lost their specific edge, and ultimately failed.
Oh, that is a completely legitimate historical risk. Hubris has destroyed many, many tech empires. However, NVIDIA's counter-argument is that they basically have no choice but to build the CPU themselves to protect their own supply chain of performance.
How do you mean?
Think of it this way. If you build the fastest race car engine in the world, the GPU, but the only tires available on the market, the third-party CPUs cannot handle the speed, well, your engine is completely useless.
Oh, I see.
If Nvidia does not control the CPU that orchestrates the data, their multi-million-dollar GPUs could just get bottlenecked by someone else's inefficient hardware. By building Vera, they ensure the entire AI factory runs at absolute maximum efficiency, which obviously drives down that cost per token.
So they are ruthlessly securing their own ecosystem. They're ensuring that if you buy an Nvidia GPU, you basically have to buy an Nvidia CPU to get the most out of it.
Exactly. It is vertical integration at the absolute highest level of advanced computing.
Which, ironically, brings us right back to the grand paradox that we started with. We have record profits, an $81.6 billion quarter, an 85% growth rate, 75% gross margins, a massive 2,400% dividend hike, an $80 billion stock buyback, and a brand new CPU that unlocks a fresh $200 billion market.
It's unreal.
Logic dictates the stock should have rocketed to the moon on that news.
But the market reaction was entirely muted.
Right.
Despite beating the incredibly high Wall Street consensus of $78.9 billion by hitting $81.6 billion, the stock actually closed lower by 1.8% on the first trading day following the report.
Unbelievable.
It was sitting right around $223.47. I mean, their market cap is a staggering $5.4 trillion, but the needle ticked downward on literally the best news imaginable.
Even their forward-looking guidance was incredible. They set Q2 guidance at a massive $91 billion.
Yeah.
And what's most fascinating about that $91 billion figure is that export licensing uncertainties.
Zero.
The U.S. government is actively restricting them from selling their best chips to one of the largest economies on Earth, and they are still guiding for $91 billion.
And this phenomenon is exactly what analysts refer to as the expectation problem.
Okay, break that down for us.
We have to view the stock market not as a report card of what just happened, but as a prediction engine for what will happen in the future.
Right.
The market is serially pricing in the next quarter's outperformance before the current quarter even finishes. When you buy a share of Nvidia today, you're not paying for the $81.6 billion they just made. You're paying a premium based on the assumption that they will flawlessly hit $91 billion next quarter and $100 billion the quarter after that.
It's basically the curse of competence.
Yes.
It's not enough to be historically great anymore. You have to be unimaginably great every single quarter without a single misstep.
Precisely. Analysts like William Ryan from Granite Shares, they articulate this perfectly. Nvidia is no longer beating a high bar. It is the bar. When expectations are priced for absolute perfection, an $81.6 billion quarter is simply met with a nod. What we witnessed post-earnings wasn't panic, it was just hedge funds taking profits. The expectations of the market have simply caught up to the incredibly high, yet very real, fundamentals of the business.
And that distinction is crucial, I think, because when people see a $5.4 trillion valuation, the immediate instinct is to scream bubble. We all remember the dot-com crash. Is this a sign of an impending AI bubble that is about to violently burst, or is this just the cold, hard reality of being the most valuable infrastructure company on Earth?
You know, the historical comparison to the dot-com bubble actually proves why this is different.
Really?
Yeah. During the dot-com era, companies were valued in the billions based on eyeballs and theoretical future revenue that just did not exist. They literally had no underlying business model.
Right, it was all hype.
Exactly. But the PitchBook data we reviewed for this deep dive suggests NVIDIA's situation is grounded in hard reality. We're seeing record semiconductor mergers and acquisitions right now. Companies are actively consolidating to build vertically integrated AI stacks because the commercial demand is tangible.
It's real money being spent.
Yeah. NVIDIA explicitly stated they are supply constrained, not demand constrained, for the entire life cycle of the new Vera Rubin platform. A bubble implies fake demand driven by hype. Right now, the demand is intensely real. The stock price just perfectly reflects that reality already.
It is priced to perfection.
Yeah.
Meaning, if they stumble even slightly, the correction will be fierce. We are looking at a company that has entirely redefined its core identity, pivoting away from the consumer gaming hardware that made them famous to become the preeminent architect of global AI factories. They are building the specialized hardware, the Vera CPUs, necessary to orchestrate a new, digital workforce of autonomous AI agents. And they are doing it with such staggering efficiency that generating $81 billion in 90 days is considered just another Tuesday by the financial markets.
It is a profound evolution. And, as we wrap up this analysis, there's a final thought from these sources that really reframes everything we just discussed.
What's that?
We have spent this time analyzing agentic AI, tokens, and data centers, all of which exist purely in the digital realm. But Nvidia is aggressively pushing into what they call physical AI. Over the last 12 months alone, physical AI generated more than $9 billion in revenue for them.
Wait, when you say physical AI, are we talking about robotics, like
No?
moving the AI out of the server and into machines that actually interact with the real world?
Exactly. The sources detail that Nvidia is partnering with Uber to deploy a fully autonomous robotaxi fleet across nearly 30 cities by 2028. They're expanding deeply into industrial robotics, automating assembly lines, and even advancing surgical robotics in hospitals. They are taking the localized intelligence we discussed with the ACIE segment and putting it into moving machines.
That is a deeply provocative thought to walk away with. If Nvidia has already established itself as the fundamental operating system for the digital AI economy, like processing the world's text, code, and data, what happens to the physical world when their hardware becomes the default operating system for reality?
Yeah.
Like when their chips are the standard mechanism driving our cars, operating our heavy manufacturing, performing complex medical surgeries, and managing our global telecommunications grids.
They cease to be a simple technology provider. They basically become the underlying infrastructure of modern human life.
We were quite literally watching the rules of the physical and economic world be rewritten in real time by a single silicon company. Thank you for joining us on this deep dive into the numbers behind the narrative. Keep questioning the world of tech and finance. Keep looking past the headlines to understand the mechanisms underneath, and we will catch you next time.